So imagine a company, right? And they're reporting these just massive, record-breaking billion-dollar profits.
Oh, yeah. The kind where the stock chart is just this beautiful, steep green mountain.
Exactly. Wall Street is cheering. The financial press is, putting their CEO on the cover of every magazine. And retail investors are just tripping over themselves to buy in.
Right. Everyone wants a piece of the action.
But, and here's the crazy part, if you knew exactly where to look, like if you just examined one specific line item on this single boring spreadsheet buried way in the back of their annual report, you'd see it.
See, that the whole thing is a house of cards.
Yeah. You'd see this company is actually like 30 days away from total bankruptcy. Welcome to the deep dive. Today, we are peering behind the curtain of corporate illusion.
And that scenario you just described, it's not just theoretical. I mean, we've seen it time and time again.
Enron, Lehman Brothers.
Exactly. The surface level numbers look absolutely phenomenal, but the structural foundation underneath is just crumbling. And uncovering that truth, well, that's the entire essence of rigorous company analysis.
Which is perfect, because for you listening right now, the MBA student who is currently getting ready to conquer your exams, this is essentially your battle plan.
Right. We are tackling company analysis straight out of Chapter 7 of your security analysis and portfolio management coursework.
Yep. And our mission today is highly specific. We're taking what is, frankly, an incredibly dense, formula-heavy textbook chapter, and we are going to transform it into this fluid, logical, mental map.
So by the time we finish this deep dive, you won't just be memorizing a bunch of financial statements or ratios and valuation models.
No, you'll actually understand the underlying machinery of why they work. So when you're sitting there taking your test, you can easily pull them from your memory and, more importantly, use them in your actual career later.
To set the stage here, we really need to place company analysis in its proper context, right? Like within the broader investment journey.
Yeah, the top-down approach.
Exactly. In your coursework, you've likely learned that top-down method. An investor starts way up at the macro level, analyzing the global and domestic economy as a whole.
Are interest rates up? Is GDP growing? That kind of stuff.
Right. And then next, they narrow their focus to a specific industry, say renewable energy or telecommunications.
Okay, makes sense.
But after identifying a thriving economy and a booming industry, they face the ultimate decision, which is picking a specific stock. And company analysis is that final, crucial step.
Because it answers the question of exactly where to put your money.
Precisely. Because you can find this phenomenal, rapidly growing industry, but it will still be littered with poorly performing, badly managed companies that will just destroy your wealth.
Yeah, like picking the right neighborhood doesn't mean you bought a house with a good foundation, right?
That's a great way to put it.
So to build this foundation for your exam, we aren't just going to wade blindly into the dry academic theory. We're going to start with, like, the ultimate cheat sheet.
Oh, the Buffett framework.
You guessed it. Let's frame this entire subject around the framework used by the greatest investor of our time, Warren Buffett. He operates on these 4 core tenets of investing.
And by viewing your textbook material through his lens, how he actually allocates billions of dollars, you connect all that dry theory to real-world wealth creation.
Exactly. So walk us through these tenets.
Well, Buffett's 4 tenets are masterful because they perfectly bridge the qualitative and the quantitative. The framework is divided into business tenets, management tenets, financial tenets, and market tenets.
Okay, let's start with the business tenets.
Sure. Buffett essentially asks 3 gateway questions before he even glances at a spreadsheet. First, is the business simple and understandable?
Right.
Second, does the business have a consistent operating history? And third, does it have favorable long-term prospects?
Let's translate that simple and understandable part for a modern context because it's so important. He basically means avoiding companies where the revenue model is so convoluted that you'd need like a PhD in higher mathematics just to figure out how cash enters the register.
Oh, completely.
Like if a company's primary business is manufacturing and selling consumer goods, okay, that's understandable.
Yeah, they make a shoe, they sell a shoe.
Exactly.
No.
But if their primary business is trading obscure, highly leveraged financial derivatives based on, weather patterns in a specific hemisphere.
You have a black box.
Right. You have a black box. And if you don't understand the inputs, you can never trust the outputs.
Which ties directly into his demand for a consistent operating history. Because think about it. If a company pivots its core business model every 2 years, moving from software to hardware, then to crypto, then to artificial intelligence, just to chase trends.
Just following the hype cycle.
Right. How can an analyst possibly project its long-term prospects? You need historical data to model future performance.
Which makes total sense. So what's the next category?
That leads us to the management tenets. Here, the focus shifts to the actual people running the machine. He asks, is management rational? And is management candid with its shareholders?
Rationality is such a fascinating metric to me because it's usually revealed in how they spend their cash. Right?
Oh, always. Follow the money.
Yeah, like are they reinvesting profits wisely to grow their core advantage, or are they just empire building?
We see that all the time.
Right, you see a CEO buy up these completely unrelated, unprofitable businesses just so they can manage a larger conglomerate and justify this massive bonus.
Exactly. And that second part, being candid, that is the true test of leadership. When you sit down and read an annual report, does the CEO actually admit their strategic mistakes?
Or is every single failure blamed on, like, vague macroeconomic headwinds or supply chain disruption?
Yes. If management cannot clearly articulate why a quarter went poorly, or if they refuse to take responsibility, they just cannot be trusted with your capital.
Okay, so that's business and management, both qualitative. What's next?
Now, the third category is where we transition into the hard numbers, the financial tenets. So Buffett advises focusing on return on equity rather than simply looking at earnings per share.
We'll definitely dig into those ratios later.
Oh, we will. He also looks for what he calls owner earnings. This means stripping away all the accounting noise to find the actual cash the business generated.
Real cash, not paper profits.
Right. He demands companies with high profit margins. And finally, he applies this very specific, really ruthless rule regarding retained earnings.
Oh, I love this rule. This is crucial for the exam.
It is. He says for every dollar retained by the company, make sure the company has created at least $1 of market value.
Yeah, I really want to highlight that specific rule for the listeners because it is the ultimate litmus test for capital allocation.
It really is.
Think about it. If a company makes $1 million in pure profit, they have a choice. They can pay it out to me, the shareholder, as a cash dividend.
Which is great for you.
Right. But if they choose not to pay me and instead keep my money inside the company, they're making an implicit promise. They better use my retained money to increase the overall market value of the company by at least $1 million.
Otherwise, what's the point?
Exactly. If they retain my cash and invest it in some failing pet project, they haven't just lost money. They have actively destroyed my wealth.
Yeah, it forces management to prove they can generate a higher return internally than you, the investor, could generate externally if they had just given you the cash.
Perfect. And the last tenet.
Finally, we have the market tenets. This is the culmination of the whole analysis. What is the true intrinsic value of the business? And, crucially, can the business be purchased at a significant discount to that fundamental intrinsic value?
The classic margin of safety. Buy $1 for 60 cents.
Exactly. So if we look at those four tenets, they perfectly mirror the two halves of company analysis that are heavily tested in your MBA exams.
Right. Financial analysis and qualitative analysis.
Yes. Financial analysis is the quantitative side. The assets, liabilities, cash flow, profitability, and non-financial or qualitative analysis covers everything else.
Like the organizational structure, product range, market share.
Industrial relations, government policies, industry life cycles, trade unions, statutory controls, all of it.
So for the exam, you really must articulate why both halves are absolutely necessary. Because they serve completely different diagnostic functions.
They do. Financial analysis is the historical record. It tells you exactly what happened up until yesterday.
Right.
Qualitative analysis evaluates the environment to tell you if those historical results can actually continue to happen tomorrow. You cannot drive a car by only staring into the rearview mirror.
No, you'd crash immediately.
And you cannot invest by only looking at historical financial statements.
I sometimes see students struggle with how to separate these two clearly in an exam essay. So let's build a quick mental model.
Sure.
Think of qualitative analysis, like analyzing the soil, the bedrock, and the zoning laws of an empty lot where you want to build a skyscraper.
Okay, I like that.
It's the environment, right? The labor-union relations, the risk of government intervention. Then, financial analysis is the engineering report of the building after it's actually constructed. The structural stress tests, the weight-bearing loads.
That's a great analogy.
But let me step into the shoes of the skeptical MBA student for a second here.
Play devil's advocate.
Yeah. If the engineering report, the financial statements, shows that the building is incredibly profitable year after year, shouldn't those numbers eventually reflect any underlying qualitative problems anyway?
What do you mean?
Like, if the trade union is striking, the profit will obviously drop. So why analyze them separately? Just look at the math.
It's a critical distinction. Yes, the numbers will eventually reflect the qualitative problems. But by the time a labor strike or a hostile government policy shows up as a loss on the profit and loss statement, it is entirely too late.
Because the market already reacted.
Exactly. The stock price will have already collapsed. Qualitative factors are your leading indicators, while financial statements are your lagging indicators.
Oh, leading versus lagging. Put that in your exam answers, folks.
Seriously, write that down. If you only look at the financials, you are essentially waiting for the building to visibly crack before you acknowledge that you built it on a fault line.
Wow, yeah. The financials are the autopsy, but the qualitative is the physical exam while the patient is still walking around.
Spot on.
Okay, that makes perfect sense. But to conduct that financial autopsy, we first need to know where the numbers actually live, right? We need to dissect the financial statements.
Right. The financial statements are the raw material of quantitative analysis. Now, for students in India taking this exam, the regulatory framework is heavily tested.
So pay attention to the legal acts here.
Yes. The preparation of the balance sheet and the profit and loss account is strictly mandated by the Companies Act of 1956 and its major overhaul in 2013.
Got it.
Additionally, the preparation of a cash flow statement is mandated by Accounting Standard 3, which is issued by the Institute of Chartered Accountants of India, or ICAI.
There is a specific threshold for that mandatory cash flow statement, though, correct? They don't make every tiny business do it.
Good memory. Yes, the cash flow statement is mandatory when a company's turnover exceeds 50 crore rupees or if its debt or equity is listed on a recognized stock exchange.
Okay, 50 crores are publicly listed.
Correct. And these three documents, the balance sheet, the P&L, and the cash flow statement, they form the foundational triad of historical financial analysis.
Let's break these down mechanism by mechanism so you aren't just memorizing definitions, but you actually understand how they interact with each other.
Let's do it.
First, the balance sheet. This document shows the assets, the liabilities, and the owner's equity at a very specific frozen point in time.
Right. It is a snapshot.
Yeah, taken at exactly midnight on the last day of the financial year.
But the trap for young analysts here is confusing book value with market value.
Oh, that is a fundamental concept to get right. The balance sheet records assets based on accounting principles, which most often means historical cost minus depreciation, meaning what you originally paid for it, less wear and tear.
Exactly. It does not necessarily reflect what that asset could actually be sold for today in the open market.
Give us an example.
Sure. Say a legacy manufacturing company bought prime real estate in Mumbai 50 years ago. Its book value on the balance sheet might be incredibly low, perhaps just a few lakhs.
Because they bought it in, like, 1974.
Right. But its true market value today could be hundreds of crores.
Huge hidden value there.
Conversely, a company might hold highly specialized manufacturing equipment on its balance sheet for millions, but if the technology is suddenly obsolete, its actual market value is essentially zero. Nobody wants to buy it.
So book value is what you paid, but market value is what it can actually earn today.
Perfectly summarized.
Next is the profit and loss account, also known as the income statement. So unlike the frozen snapshot of the balance sheet, the P&L is more like a motion picture.
Right, it tracks flow.
Yeah, it shows the financial operations over a period of time, usually a full year or a quarter. It tallies all the revenues, subtracts the expenses, and arrives at a net profit or loss.
And then we have the cash flow statement. This one strips away all the theoretical accounting rules and simply tracks the actual physical cash entering and leaving the company's bank accounts.
This is my favorite statement.
Because it's the hardest to fake. This statement is crucially different from the P&L because modern finance relies heavily on accrual accounting. And really understanding the gap between the P&L and the cash flow statement, that is where real financial analysis begins.
Absolutely. Accrual accounting is like the single biggest stumbling block for new students. So how does it actually work in practice? Let's clarify it.
Well, accrual accounting requires companies to record revenues and expenses when the underlying transaction occurs, completely, regardless of when the cash actually changes hands.
Okay, so give me a business scenario.
For instance, a company can ship $10 million worth of heavy machinery to a client on December 31st. Under accrual accounting, they record that $10 million in revenue on their P&L for that year.
And suddenly they look phenomenally profitable on paper.
Exactly. But if they offered the client 90-day payment terms, the company hasn't actually received a single dollar yet. The bank account hasn't changed.
I always like to use the dinner party analogy to explain this one.
Oh, let's hear it.
Think of the P&L with accrual accounting, like promising to pay for a big group dinner. You put a $100 meal on your personal credit card,
Yeah.
and your 4 friends all promise to Venmo you $20 each.
Okay.
So on your personal P&L, you are whole. You recorded the revenue because the promise was made by your friends. You look financially sound.
You're balancing the books in your head.
Right. But the cash flow statement is you standing out in the parking lot, checking your physical wallet to see if you have enough actual physical cash to tip the valet.
And if everyone promised to pay, but nobody actually hit send on Venmo?
Your P&L shows a perfect balance, but your cash flow is negative. You are broke, and the valet is angry.
That perfectly illustrates the danger. I mean, a company can report record profits on its P&L and still go bankrupt the very next day because they literally ran out of cash to pay their employees.
Which is exactly the scenario I brought up at the very beginning of the deep dive.
Exactly. This disconnect is precisely why the cash flow statement is the ultimate truth teller. However, while financial statements are legally required to depict a quote-unquote true and fair view of the company, they are still outputs of a subjective reporting system.
Subjective.
Yes, management has significant leeway in choosing their specific accounting policies.
Okay, let me push back on this a bit on behalf of our listeners, because these statements are audited by massive, globally recognized accounting firms, right?
Right, the big four usually.
So how does subjectivity creep in if an auditor is legally signing off on the document? Isn't an audit a stamp of absolute objective mathematical truth?
That is a very common misconception. An audit merely verifies that the company followed accepted accounting rules. But those rules are not rigid mathematical laws like physics. They are frameworks that allow for multiple, entirely legal methods.
Give me an example of a legal but subjective method.
Let's look at inventory valuation. Say we are in a period of high inflation, so the cost to manufacture a product is rising every month. Management can choose the first-in, first-out method, commonly known as FIFO.
Okay, FIFO.
Under FIFO, they record their oldest, cheapest inventory as their cost of goods sold for the current quarter.
Ah, I see. So if they manufactured a widget for $5 2 years ago, but because of inflation it cost $10 to make that same widget today.
FIFO allows them to claim the cost of the sale was only $5 when they sell it today for, say, $15.
Wow. By legally choosing FIFO during inflation, they are artificially deflating their expenses and inflating their reported profit margin for the quarter.
Exactly. Management looks brilliant, the profit margin spikes, the stock goes up, and the auditor signs off because FIFO is a perfectly legal accounting method.
But as an analyst, you know that this is a phantom profit. Because to replace that widget tomorrow, the company will have to spend the full $10, not $5.
Precisely. Their future cash flow will be heavily squeezed. And this is exactly why reading the notes to accounts, the extensive fine print attached to the financial statements detailing these policy choices is absolutely mandatory.
It's where the bodies are buried.
It really is.
And sometimes management goes far beyond just choosing flattering legal accounting methods, right? Sometimes they cross the line into outright misrepresentation or fraud.
Unfortunately, yes.
Our textbook sources outline 19 specific red flags. These are indicators of fraud or severe misrepresentation in financial statements. Now, we won't list all 19 here, but we really need to highlight the mechanics of the most critical ones so you can spot them on an exam.
One major red flag is unexplained. Sudden changes in accounting policies and estimates, particularly during difficult economic times.
What does that look like?
Well, if an industry is facing a massive downturn and a company suddenly changes how it recognizes long-term contract revenue completely out of the blue, that is a glaring signal that they are just trying to paper over operating losses.
We didn't lose money, we just count it differently now.
Exactly. Another critical warning sign is an unusual increase in debtors and inventories in relation to sales.
Let's dissect the mechanics of that one. Because if a company's sales are growing at a steady, say, 5% a year, but their inventory is suddenly growing at 30% a year, what does that actually look like on the factory floor?
It means the factory is running at full capacity, churning out goods that nobody is actually buying. The inventory is literally piling up to the ceiling in the warehouse.
Which is a disaster.
It is, because eventually they will have to slash prices to clear it, destroying their profit margins, or they'll have to write it off entirely as a loss.
And what about debtors?
Right. So if debtors, which are accounts receivable, basically the clients who owe the company money if they're growing significantly faster than sales, it often indicates a practice called channel stuffing.
Channel stuffing. I love that term. That's where a company aggressively ships excessive amounts of product to its distributors right before the quarter ends, just to record the sale on the P&L, right?
Yes. But to get the distributors to actually accept all that unwanted product, the company has to extend extremely loose, risky credit terms.
Pay us whenever, just take the boxes today.
Exactly. So they record the revenue today to hit their targets, but they might never actually collect that cash.
Another huge red flag I saw in the notes is a company boosting its profits via non-operating assets or one-time transactions.
Oh, this is a classic trick.
Imagine a company whose core business is manufacturing textiles. They report a record-breaking profit for the year. Wall Street is thrilled. But when you actually dig into the income statement, you realize their textile operations actually lost money.
They're bleeding cash from their core business.
Right, and the only reason they showed a net profit at the bottom line is because they sold their corporate headquarters and leased it back.
They are literally selling the furniture to pay the rent. It makes the current year look great, but it is entirely unsustainable. I mean, you can only sell the headquarters once.
Exactly. You also need to look out for SPVs. The source material specifically flags the presence of special-purpose vehicles, or special-purpose enterprises.
Yes, SPVs are a major area of scrutiny.
See, I was looking at the notes on off-balance sheet items, and these SPVs kept coming up. Historically, I thought an SPV was just a standard, boring corporate subsidiary used for a specific project, like building a toll road or something.
And they are used for that, yes.
So how does a seemingly legal standard entity get weaponized to commit massive fraud?
Well, while STVs do have legitimate uses in isolating financial risk for massive infrastructure projects, their legal structure allows them to be used to hide debt, obscure ownership, and artificially inflate earnings.
Just hide the garbage in a different bin.
Exactly. Enron is the textbook example here. Enron transferred its failing toxic assets to off-balance sheet SPVs. And because Enron technically didn't own the SPVs outright on paper, the massive debts and losses of the SPVs did not show up on Enron's consolidated balance sheet.
Unbelievable.
To the public, Enron looked incredibly profitable and totally debt-free, while the SPVs were secretly holding billions in hidden liabilities.
So as an analyst, if you find a labyrinthine structure of unexplained SPVs combined with a weak, complacent board of directors, you should just assume the numbers are manipulated.
That is the safest assumption, yes.
Now, the final red flag we should emphasize before we look at a real case study is the increasing gap between different types of reported income.
The tax gap.
Yeah. If management reports a massive accounting profit to their shareholders to drive the stock price up, but simultaneously reports a tiny taxable income to the government to avoid paying taxes.
You're telling two completely different stories to two different audiences.
Exactly. And the truth is usually somewhere in the muddy middle.
Well said. So, to bring all of these abstract concepts into sharp reality, let's examine the actual case study provided in your materials.
The Nestle India one.
Yes, the standalone balance sheet for Nestle India Limited spanning from December 2012 to December 2016. Because in an exam, you won't just be asked to define a balance sheet. You'll be handed a table of numbers like this and asked to interpret the narrative.
You have to tell the story of the numbers.
Right. So a balance sheet is fundamentally divided into two main sections, sources of funds and application of funds.
The simplest way to remember this under exam pressure is, where did we get the money and what did we buy with the money?
Exactly. Under sources of funds, you look at share capital and reserves, which together form the net worth. That's the money belonging to the owners.
Okay.
Below that, you have secured and unsecured loans, which constitute the total debt. That's the money borrowed from outsiders.
Got it.
So let's look closely at Nestle India's unsecured loans during this period. In 2012, they held roughly 1,049 crores in unsecured debt. In 2013, that increased slightly to 5,189 crores.
Pretty standard so far.
But then, an analyst looks at 2014 and sees a massive, jarring anomaly. The unsecured loans dropped from 11,189 crores all the way down to just 15.46 crores.
Whoa. They practically wiped out over 1,000 crores of debt in a single 12-month window.
They did.
And in an exam, you can't just write debt went down. That gets you no points. You have to ask how they achieved that.
Right.
Did they issue a massive amount of new stock to pay it off? Did they sell off their core factories? Or did their core operations suddenly generate an absolute tsunami of free cash flow?
To answer that, you have to look at the application of funds, what they did with the capital. This section includes the gross block, which is the total historical cost of their fixed assets like factories and machinery.
Okay.
Subtracting accumulated depreciation gives you the net block. You also track investments, inventories, sundry debtors, and cash and bank balances. These short-term assets form the total current assets.
So what happened with Nestle?
Well, while Nestle was wiping out its debt in 2014, look at what happened to their investments shortly after. Their investments jumped from about 851 crores in 2013 to 1,324 crores in 2015 and surged again to 1,749 crores in 2016.
Oh, wow. So the narrative begins to form right there. They didn't just pay down debt. They were aggressively funneling excess cash into new investments at the same time.
Exactly.
They transitioned from a heavily leveraged position to a highly liquid, investment-heavy position in just a few years. That indicates a business generating tremendous operational cash flow, which allowed them to clean up their balance sheet and build a war chest simultaneously.
That is the absolute essence of company analysis. You interrogate the numbers to find the underlying operational reality.
It's like detective work.
It is. But having the raw statements is just step one. Analysts don't just eyeball the numbers and guess. They rely on a specific toolkit of analytical techniques to standardize the data and uncover hidden trends.
And for the exam, you really need to know the specific terminology of these techniques, so let's break them down. First up, comparative financial statements. This is also frequently referred to as horizontal analysis or interfirm comparison.
Right. Horizontal analysis is all about tracking the flow of time. You place the financial statements of a single company over multiple years side by side, arranging the line items in rows and the years in columns.
Right, reading left to right.
You calculate both the absolute change in rupees and the percentage change from one year to the next. This allows you to immediately see if revenue is accelerating or if costs are spiraling out of control over time.
Makes sense.
However, there is a strict mathematical constraint you must state in your exam here. If the base year figure is negative, for instance, if the company went from a loss to a profit, or if the base year is a zero balance, you cannot calculate a percentage change.
Right, because dividing by zero breaks the laws of mathematics. You'll just get an error on your calculator.
Exactly.
And there is a massive warning label attached to the interfirm part of comparative statements. Comparing the absolute numbers of two different companies can be wildly misleading.
Oh, totally.
If you compare a massive multinational conglomerate to a nimble regional startup using absolute rupees, the data is completely useless. The conglomerate's paperclip budget might be larger than the startup's entire revenue.
It's apples and oranges.
Furthermore, if the two companies use different accounting policies like we talked about, one using FIFO and the other using weighted average for their inventory, a direct horizontal comparison is fundamentally flawed.
Which is exactly why we use trend analysis to smooth out the noise. Trend analysis involves selecting a specific, quote-unquote, normal base year and assigning it an index value of 100.
Okay, 100 is the baseline.
You then calculate the percentage relationship that every subsequent year bears to that base year. So if your base year sales are indexed at 100 and year 2 is 110, you instantly know sales grew 10%.
Simple enough.
It really helps you spot long-term, favorable or unfavorable trajectories, filtering out short-term volatility.
But what if I do want to compare that massive multinational conglomerate to the regional startup? How do I strip away the distortion of their massive difference in size?
Ugh. That brings us to common size statements, also known as vertical analysis.
Vertical instead of horizontal.
Yes. This is where you express every single figure on the statement as a percentage of a common base. So on the P&L, total sales are set as 100%, and every single expense is expressed as a percentage of those sales.
And on the balance sheet.
On the balance sheet, total assets are 100%. Converting absolute figures into these vertical percentages creates a static relationship existing at a particular date.
It reveals the internal architectural structure of the company's finances.
Exactly, making it incredibly easy to compare companies of vastly different sizes.
I always visualize common size statements like scaling a baking recipe.
Oh, the cake recipe analogy.
Yeah. Imagine you have a recipe for a cake that feeds 2 people and a recipe from an industrial bakery that feeds 2,000 people. If you just look at the absolute grams of sugar and flour, you can't really compare them.
The numbers are too far apart.
Right, but if you convert both recipes to percentages, say flour is 40% of the total weight and sugar is 20%, you can instantly compare the internal structure.
That's a perfect way to look at it.
If Nestle's cost of goods sold is 40% of their total sales, and the small startup's cost of goods sold is 60%, I immediately know that Nestle has far superior manufacturing efficiency and pricing power. And it's completely regardless of the fact that Nestle makes billions and the startup makes thousands.
That analogy holds up perfectly. Vertical analysis normalizes the playing field.
Okay, what's next?
Beyond the structural analysis, we also have the fund flow statement. Now, while the cash flow statement strictly tracks physical cash moving in and out, the fund flow statement is broader. It analyzes the changes in working capital between two balance sheet dates. It reveals the sources and applications of funds generated or lost in daily operations.
So it's a bridge.
Yes, it bridges the gap between the static balance sheet and the accrual-heavy P&L, showing you exactly how the company financed its day-to-day existence over the year.
All right, so we have the horizontal analysis showing us the timeline and vertical common size statements showing us the structural architecture.
Right.
But how do we stress test the specific organs of the company? How do we measure the pulse, the blood pressure, the lung capacity of the business?
Time for the math.
That brings us to the mathematical trench warfare of company analysis. This is the most heavily tested section of your MBA exam, ratio analysis.
Ratios are simply the mathematical relationship between two or more figures extracted from the financial statements. But I have to warn you, memorizing dozens of formulas is useless if you don't actually understand the narrative they create.
So true.
Ratios generally fall into distinct categories based on who is asking the question. Valuation, liquidity, profitability, debt or leverage, productivity or efficiency, and cash flow and earnings.
Let's group these by narrative logic so everyone can study efficiently. Let's start with the perspective of the broader market. How does the public value the stock? These are the valuation ratios.
Okay, valuation.
First is the dividend payout ratio. Instead of just memorizing dividend per share divided by earnings per share, think about the relationship. It tells you what percentage of the company's total profits management is actually willing to hand back to the shareholders as hard cash.
Right, are they stingy or generous?
Exactly. Next is dividend yield, dividend per share divided by the current market price. This is exactly like looking at the interest rate on a savings account. If I buy the stock today at this specific price, what is my annual cash return just from dividends?
Simple enough. Then we arrive at the most famous and frankly most frequently misinterpreted ratio of all, the price-to-earnings ratio, or PE.
The classic PE.
It is the current market price per share divided by the earnings per share. The PE ratio measures the premium the market is willing to pay for the company's earnings.
Give me a benchmark.
Well, a high PE ratio, say 50 or 60, signifies that investors have massive expectations for future growth. They are willing to pay a very high price today for profits they expect tomorrow.
But that makes it a highly volatile, risky investment, doesn't it?
Oh, incredibly risky. If the company misses those growth targets by even a fraction, the narrative shatters and the stock price will crash violently.
And here is an important mathematical constraint for the exam. If a company is losing money, if they have negative earnings, they do not have a PE ratio.
Right.
You cannot calculate a negative PE. Just write NA on the test.
Exactly. But looking at the PE in isolation is really dangerous. I mean, a PE of 30 sounds expensive, but what if the company is doubling its profits every single year?
Then it's actually cheap.
Right. That's why analysts use the PEG ratio, the price-earnings growth ratio.
Break that one down for us.
To calculate the PEG ratio, you take the standard PE ratio and divide it by the company's year-over-year earnings growth rate. The PEG ratio normalizes the PE by factoring in velocity.
How fast it's moving.
Yes. So if a company has a PE of 30, but its earnings are growing at 30% a year, its PEG ratio is 1.0.
Okay.
But if another company has a PE of 15, which sounds cheaper, but is only growing at 5% a year, its PEG ratio is 3.0. In general, the lower the PEG, the better the value, because you are paying less for each unit of future earnings growth.
Okay, so valuation ratios tell us if the stock is cheap or expensive over the next decade. But what if the company can't even keep the lights on tomorrow?
Ah, liquidity.
Yeah, how do we test if they're going to survive the week? That brings us to liquidity ratios. This is all about short-term survival. The first is the current ratio. Total current assets divided by total current liabilities.
Understanding the perspective of different stakeholders is vital here. Short-term creditors, like suppliers or banks holding short-term notes, love a high current ratio.
Because it means they get paid.
Right. If a company has $2 in current assets for every $1 in current liabilities, a ratio of 2.0, the creditor feels completely secure. The company is highly liquid. However, from a shareholder's perspective, a massive current ratio might actually be a negative signal.
Why? Because idle cash is lazy cash.
Exactly.
If a company has a current ratio of 5.0, they are hoarding mountains of cash or letting inventory just sit idle. They aren't deploying those assets to build new factories, research new products, or generate returns. They are prioritizing safety over growth to a massive fault.
Moving to a stricter standard of survival, we have the quick ratio, also known as the acid test. The formula takes current assets, strictly subtracts inventory, and then divides the remainder by current liabilities.
Okay, wait. Why do we completely remove inventory from the equation? Isn't inventory a valuable asset that the company owns?
It is an asset on paper, absolutely, but it is not always a rapidly liquid asset in reality.
I see. It's like trying to pay your emergency room medical bill with a warehouse full of unsold winter coats in the middle of July.
That's a great visual.
Yes, the coats have theoretical value, but the hospital demands cash today. If the market for your product suddenly dries up, or a competitor releases a much better version, your inventory becomes dead weight. You cannot pay your electric bill with unsold inventory.
Exactly. The quick ratio is a severe test of whether the business could survive an immediate catastrophic shock to its sales.
And the most draconian test of all.
That would be the cash ratio. This numerator only includes actual cash in the bank and highly marketable, easily sold securities divided by current liabilities. It completely ignores both inventory and accounts receivable.
Wow, ignoring accounts receivable too.
Yes, it asks a terrifying question. If the global economy halted today and not a single customer paid the money they owe us, could we still pay our immediate debts?
That is a brutal test. Okay, having survived the short-term liquidity tests, we move to the category that shareholders care about most: profitability ratios.
The fun part.
Yeah, how efficient is the wealth creation machine? First is return on assets, or ROA, earnings after tax divided by total assets. It measures how effectively management is using every single piece of equipment, every patent, and every dollar in the bank to generate a net profit.
Then we have return on equity, or ROE, net income divided by shareholders' equity. For equity investors, ROE is the ultimate bottom line.
Because it's my money.
Exactly. It answers a very personal question. For every dollar of capital I surrendered to this business, how many cents of profit did management actually generate for me?
But there is a critical, frequently tested nuance for your exam regarding the formula here.
Yes, regarding preference shares.
Exactly. When calculating the net income for the numerator of ROE, you must use the income available exclusively to equity shareholders. This means you must explicitly deduct any mandatory dividends paid to preference shareholders first.
And the denominator.
Similarly, the shareholders' equity in the denominator must exclude the value of preference shares. It has to be a pure measure of common equity return.
That's a great tip for the exam. Next, we have the profit margin. Profit after tax multiplied by 100 divided by net sales. Simply put, for every $100 of revenue that comes through the door, how much of it actually survives the gauntlet of expenses and makes it to the bottom line?
And finally, return on capital employed, or ROCE. The formula is profit before interest and tax divided by capital employed. Now, why do we specifically use profit before interest and tax here when we use net income for ROE?
Because ROC is designed to measure the pure operational efficiency of the capital utilized, completely regardless of how management chose to finance that capital.
Oh, I see.
Think about it. The operations manager in the factory doesn't control whether the CEO borrowed money from a bank or issued stock to buy the machinery. The factory just needs to generate revenue.
Right, it's not their fault there's debt.
Exactly. By ignoring interest, which is the cost of debt, and tax, which is a government variable, ROCE isolates the pure operational profitability of the business model itself.
That distinction between operational efficiency and financing choices leads us perfectly into our next category: debt or leverage ratios.
How much borrowed money is fueling the machine?
Exactly. The debt-to-asset ratio is straightforward. Total debt divided by total assets. It shows the proportion of the company's assets financed by creditors.
And the debt-to-equity ratio compares total debt to net worth. If this ratio is greater than 1.0, the majority of the company's operations are financed by the bank, not the owners.
In an exam, you must demonstrate an understanding of the dual volatile nature of leverage.
It's a double-edged sword.
Borrowing money at a fixed, predictable cost to earn a higher return on operating assets is the magic of leverage. If a company can borrow $1 million at a 5% interest rate and deploy that capital to earn a 12% return on assets, leverage is accelerating shareholder wealth brilliantly.
But as debt increases, the risk profile and the volatility of shareholder returns expand exponentially.
Right. Because a bank doesn't care if a global pandemic hit, or if your supply chain collapsed, or if you just had a terrible quarter. They demand their fixed interest payment on the first of the month, every single month.
Which brings us to the ultimate test of debt sustainability, the interest coverage ratio.
The survival metric for debt.
Yes. The formula is earnings before interest and taxes, or EBIT, divided by interest expenses. This ratio measures the margin of safety for creditors.
Give us an example.
If a company's EBIT is $10 million and their annual interest expense is $1 million, their coverage ratio is 10. They have a massive cushion.
They're super safe.
But if their EBIT is $2 million and their interest is $1.5 million, the ratio is dangerously low. A single economic hiccup, a slight dip in sales, and they simply won't generate enough cash to pay the bank. They will face insolvency.
Okay, the final major ratio category is productivity or efficiency ratios. These measure the velocity of the business. How fast are they turning assets into sales?
Right. Asset turnover ratio is total turnover, meaning sales divided by total assets.
And inventory turnover is the cost of goods sold divided by the average inventory held during the year.
A low inventory turnover ratio is a severe warning sign. It means capital is tied up in products that are just sitting on warehouse shelves, gathering dust, becoming obsolete, and incurring storage costs.
Like the winter coats in July.
Exactly. High turnover means the product is flying off the shelves as fast as it is produced. We also look at fixed asset turnover, sales divided by fixed assets.
The less heavy machinery, land, and factories you need to generate $1 of sales, the more capital efficient your business model is.
We also have cash flow specific ratios. Sales to cash flow ratio, which is sales per share divided by cash flow per share. Higher is always better.
And the standard per share metrics, right?
Mm-hmm.
Earnings per share, or EPS, which is the earnings available to equity shareholders divided by the total number of outstanding equity shares.
And dividend per share, or DPS, the total dividend paid out divided by the number of shares. That completes the ratio rundown.
Man, it is a massive amount of math.
It is.
But all of this mathematical trench warfare, the horizontal scaling, the liquidity stress tests, the profitability margins, it all serves one ultimate singular goal for the investor.
Because the goal isn't just to build spreadsheets for fun.
No. The goal is to synthesize all this data to answer one single question. What is this specific piece of paper, this share of stock, actually worth today?
That brings us to the concept of estimating intrinsic value. Intrinsic value is the true underlying fundamental value of the shares.
The real worth.
Yes, it is the theoretical price backed by the tangible quality of the assets, the proven earning capacity, the calculated risks, and the reasonable potential for future performance.
So it's not just the stock price on the screen.
No, the core philosophy of fundamental analysis is that the stock market is often completely irrational in the short term, but rational in the long term. Therefore, the chaotic market price will eventually gravitate toward the solid intrinsic value.
The textbook provides a baseline formula. Intrinsic value equals expected EPS multiplied by a PE multiplier. But accurately forecasting expected EPS and determining the correct PE multiplier requires immense analytical judgment.
It's an art and a science.
So how do professional analysts actually arrive at a valuation in the real world?
There are broadly two primary techniques used in modern finance. The first is calculating the present value of cash flows, or PVCF. This category includes complex models like the dividend discount model, or DDM, the present value of free cash flow to equity, FCFE, and the present value of free cash flow to the firm, FCFF.
Okay, let's demystify these. So they aren't just a bowl of alphabet soup acronyms for the exam. The core mechanism behind all of them is the time value of money.
A crucial concept.
$1 in your hand today is worth more than $1 promised to you 10 years from now because of inflation and opportunity cost. So models like the dividend discount model require the analyst to forecast every single cash dividend the company will pay out into the infinite future.
Which is very hard to do.
Yeah. Then the analyst must mathematically discount all those future payments back to today's value using a specific interest rate. The sum of all those discounted future cash flows is the intrinsic value of the stock today.
Precisely. If you use FCFE, you are forecasting the free cash flow available to equity holders rather than just dividends.
What's the second technique?
The second broad valuation technique is relative valuation. Instead of forecasting decades of cash flows, You use multiples.
You compare it to the neighbors.
Exactly. You calculate the price to earnings, price to cash flow, price to book value, or price to sales for your target company, and you compare those multiples to its direct competitors or the industry average.
Give me an example of how that tells you if it's a good buy.
Well, if the industry average PE is 25 and your fundamentally sound company is trading at a PE of 12, relative valuations suggest your company is significantly undervalued.
And once you have utilized these models to calculate a firm number, you apply the golden rule of fundamental analysis. It is beautifully simple.
The buy-or-sell trigger.
Yep. If the intrinsic value you calculated is greater than the current market price, BUY. The stock is cheap, it's on sale. If the intrinsic value is less than the current market price, you sell. The market has overpriced the asset.
But the evolution of financial analysis didn't stop with standard discounted cash flows. Your textbook introduces you to modern, highly advanced metrics developed by the financial consulting firm Stern, Stewart & Co. in New York.
EVA and MVA.
Yes, economic value added and market value added. Let's delve into economic value added first. The formula is net operating profit less adjusted taxes, known as NOPLAT, minus the firm's total cost of capital.
Wait, why do we need a whole new metric for profit? Doesn't the traditional profit and loss statement, which is audited by professionals, already tell us if the company made a profit?
Traditional accounting profit has a massive structural blind spot. It completely ignores the cost of equity capital. When a company calculates its net profit on a standard P&L, it faithfully deducts the interest it pays to the bank for its debt. But it does not deduct the financial expectations of its equity shareholders. The millions of dollars investors poured into the company aren't free money. There is a massive opportunity cost attached to it. Those investors expect a return.
Okay, let me use a very simple analogy to illustrate this blind spot because it's so important for the test.
Go for it.
Think about EVA, like running a neighborhood lemonade stand. Let's say I run the stand all summer, and at the end of the season, my accounting ledger says I made $50 in net profit.
Hey, $50. Nice.
Right, I look like a successful entrepreneur. But what if I borrowed the $500 needed to buy the stand, the lemons, and the sugar from my parents? And what if I promised my parents a 12% return on their investment for funding my venture?
There's the catch.
That 12% is my cost of equity capital. I owe them $60 for the use of their money. Even though my traditional P&L shows a $50 profit, my economic value added is negative $10.
You lost value.
All right, I didn't create wealth. I actually destroyed wealth.
Yeah.
Because the profit I generated couldn't even cover the invisible cost of the capital I used to generate it. Why do traditional accounting standards ignore this?
Because accounting standards are built around strict, legally enforceable liabilities. Debt is a hard contractual obligation. If you don't pay the interest, the bank seizes your assets.
But equity is different.
Equity is a residual claim. There is no legal requirement to pay dividends or provide a guaranteed return to shareholders. But Stern Stewart argued correctly that from a pure economic standpoint, capital is capital. Whether it's debt or equity, it has a cost.
So if you don't beat the cost, you're failing.
If management's operational returns aren't beating the company's total blended cost of capital, the weighted average cost of capital, or WACC, they're destroying shareholder value completely regardless of what the accounting profit says. EVA measures true economic profit.
That is a brilliant concept for an essay question. EVA separates accounting illusions from economic reality. And what about the companion metric, market value added or MVA?
MVA is the difference between the total market value of the firm, basically what the stock market says the entire company is worth today, and the total book value of the capital invested in the firm by both debt and equity holders over its lifetime.
So it measures market perception.
Yes. MVA is a measure of external market performance. It shows how the collective wisdom of the market evaluates the firm's historical and projected performance.
How do they link together?
Companies that consistently generate high EVA, meaning they generate true economic profit above their cost of capital year after year, are highly likely to have a massive MVA. In financial theory, a company's MVA is essentially the present value of all its future expected EVA streams.
Wow. So we have mapped the entire quantitative landscape. We've explored the Buffett framework, navigated the statutory financial statements, uncovered the red flags of fraud, survived the mathematical trench warfare of ratio analysis, and built complex models for intrinsic value and economic value added.
It's a lot of ground covered.
But a company isn't run by Excel spreadsheets, right? It isn't a frictionless math equation floating in a vacuum. It is a messy, breathing organization run by fallible human beings operating in a cutthroat, unpredictable real world.
Very true.
That brings us to our final section. The human element, corporate governance, and the qualitative factors that ultimately dictate whether those mathematical models will hold up in reality.
Because the quantitative math is really only as durable as the business environment supporting it. In your broader studies, you probably use Porter's 5 forces model to analyze the brutal competitive dynamics of an industry, like the threat of new entrants or the bargaining power of suppliers.
Right.
But looking specifically inward at the company itself, several qualitative factors directly affect share value. The foremost is competitive edge.
Moat.
Yes, a company's long-term survival is dictated by its ability to build a moat, a sustainable competitive advantage, whether through patents, brand loyalty, or structural cost advantages.
Next is market share. A dominant market share helps a company absorb the shocks of brutal economic business cycles far better than smaller, fragile competitors who are easily crushed in a recession.
Stability and growth of annual sales is another critical factor. We all love the narrative of a hyper-growth startup doubling sales every month. But massive, stable, predictable sales means stable, predictable earnings.
Which lets you plan ahead.
That allows management to execute long-term financial planning and pay consistent dividends, which institutional investors absolutely love. You also have to qualitatively analyze the sources of their earnings.
Is the income sustainable operating income, or is it one-off non-operating income? As we established earlier with the red flags, selling off your factories to post a profitable quarter is a death spiral, not a business model.
We must also revisit capital structure qualitatively. We discussed the leverage ratios mathematically, but management must strategically determine the perfect mix of debt and owned capital.
Because debt is cheaper.
Because interest is tax-deductible, yes, debt is a significantly cheaper source of finance than equity. The leverage effect can aggressively amplify returns to equity shareholders, but only if management possesses the restraint to strike the perfect balance and avoid taking on catastrophic existential risk.
But, and I think this is the most crucial part, the single most important variable in this entire deep dive, the variable that can override every single ratio we calculated, is management.
Without a doubt.
Even the most brilliant monopolistic business plan, perfectly modeled on a spreadsheet with a sky-high EVA, is completely doomed if the leadership team is incompetent, greedy, or corrupt.
Yeah.
So how does a remote financial analyst, sitting at a desk thousands of miles away, actually evaluate the quality of human management?
Well, one of the primary legally mandated tools is the Management Discussion and Analysis, or MD&A. This is the narrative section found at the beginning of the annual report.
Read those sometimes.
In regulatory theory, the MD&A is supposed to be a frank, honest commentary from the CEO and the board on management's outlook, the operational challenges they face, and their strategic plans for the future.
Okay, I have to challenge this on behalf of anyone who has ever worked in an actual corporate environment.
Please hear it.
How can an analyst put any real weight into the MD&A? Isn't it just highly polished, legally scrubbed corporate public relations? They hire armies of high-priced communications experts and lawyers to draft these documents.
We do.
No CEO is going to write, honestly, we completely misread the market, our competitors are crushing us, and our new product line is a total disaster.
Yeah.
They're going to use buzzwords to spin it.
That is a very cynical but entirely accurate critique, and that is exactly why a seasoned analyst never reads the current year's MD&A in isolation.
You check their receipts.
You read the current MD&A, and then you brutally verify it against their past performance. You pull the annual reports from 3, 4, and 5 years ago. You look at what management promised in their historical MD&As. Did they actually deliver?
I love that.
If the CEO claimed 3 years ago that they were going to expand profit margins through aggressive operational efficiency, but the vertical common size statements and the profit margin ratios you just calculated show margins steadily shrinking over those 3 years, you have your answer.
You know, the current MD&A is just PR spin.
You also track the individual leaders qualitatively. Where did the new CFO work before? What was the track record of those previous companies? Were they known for aggressive, shady accounting?
That is true investigative analysis right there. It's comparing the narrative to the hard math. And the structural cage that is supposed to keep management honest and aligned with the shareholders is corporate governance.
Yes. Governance describes the strict policies denoting the relationships, the power dynamics, and the responsibilities between management, the directors, and the stakeholders.
Robust corporate governance is the only thing preventing unethical activity and value destruction.
It involves transparency, Are the financial disclosures clear, detailed, and timely? And it involves stakeholder rights. Do minor shareholders actually have a voice?
Right? Do they have voting rights and access to the board to discuss pressing strategic issues?
The absolute central pillar of corporate governance is the composition of the board of directors. The board's entire legal purpose is to oversee management, hire and fire the CEO, and protect the capital of the shareholders.
And to execute this duty effectively, there is one key word you absolutely must burn into your memory for your exam: independence.
Independence, meaning the board must be a balanced combination of inside directors, executives who actually work for the company, and outside, independent directors who have no financial ties to the CEO.
Because if the entire board of directors consists of the CEO, the CEO's brother, the CEO's best friend from college, and the company's lead lawyer, there's absolute zero independence.
There are no checks and balances.
The intrinsic value you spent hours calculating is likely a total illusion because that entrenched management team can do whatever they want with the company's cash, unchecked.
If the board is captured by management, the risk profile of that investment becomes exponentially higher, regardless of what the PE ratio says. For your exam, if an essay prompt asks you to evaluate a company's future prospects based on financial data, you cannot just stop at calculating the return on equity or the debt ratio. You must explicitly integrate these qualitative factors to get top marks.
You must mention the necessity of robust corporate governance, the requirement for board independence, and the track record of management in the MD&A. And there we have it. We have covered the entire landscape. We have just conquered the sprawling architecture of company analysis.
From Buffett's foundational 4 tenets of investing through the legal maze of financial statements and the 19 red flags of accounting fraud.
We waded deep into the mathematical trenches of horizontal and vertical analysis, survived the ratio rundown, explored the advanced economic philosophy of intrinsic value in EVA, and finally brought it all back to the vital human touch of corporate governance and leadership execution.
You now possess the comprehensive mental map required to not just pass a test, but to truly understand a business. But before we conclude, I want to leave you, the MBA student, with a final provocative thought to ponder as you approach your exam and, eventually, your career in the markets.
Lay it on us.
We have spent this entire deep dive rigorously calculating the exact financial reality of a company. We have treated fundamental analysis like a hard physical science. We used absolute formulas, discounted cash flows, and stringent ratios.
We get all the math.
But remember this inescapable reality. The market price of a stock on any given Tuesday is ultimately driven by human emotions specifically, by the primal forces of fear and greed.
Yeah.
If intrinsic value is a hard mathematical truth, why does the market value fluctuate so violently every single second of the trading day? As you sit in the exam hall and build your valuation models, ask yourself a philosophical question. Are you truly analyzing the objective reality of the company, or are you actually analyzing the irrational crowd's perception of the company?
That is the ultimate puzzle of Wall Street, isn't it? The numbers on the balance sheet might be absolute, but the market itself is a volatile mob. It brings us right back to the muddy waters we discussed at the very beginning.
Exactly.
You might have built the sharpest, most sophisticated financial X-ray machine in the world, equipped with precise EVA calculations and common-size statements. But you are still pointing that machine at the chaotic, unpredictable behavior of human beings. Go crush your MBA exam. Trust the rigorous math behind your analysis, but never forget the human context that drives the price. Keep analyzing, keep questioning, and keep diving deep into those numbers. We'll see you next time.